Okay, we are recording. So, can you guys hear me? Okay, great. Let's go ahead and do this. Present. Okay, good. All right, so guys, this is a class that we taught at Georgia Tech when I was there. I was the director of mentorship for this program, the Georgia Tech Student Foundation Investments Committee. This is where we take engineers and train them in finance. So, and then they join our committee, and together we had a few $100,000 to spend, real dollars, and we make our own decisions and we manage a portfolio. Eventually, that portfolio crossed 1 million, and it was a very exciting time for all of us. So I was part of this committee for a few years. I started as an analyst and went to a sector analyst, then a director, then director of mentorship. So a lot of this is very specific to the committee. So I'm going to skip over, the mentorship session. Basically, what we wanted to do was this whole session that I'm going to take you through. They're 1 hour sessions. They are going to cover topics like careers in finance, market basics, finance accounting basics, and pitch week. So we're not going to, this was I think an 8 week class. So we're going to blast through this in a few weeks over here. Meeting, they want to skip over this mentorship calendar, skip over that. This is about the people. Okay, forget all of this. I'm just going to skip through. Okay, let's reach, okay, careers in finance, basically, right? So when you talk about a career in finance, a lot of people believe that it's very specific to like trading and investing in stocks, but the reality is that smart people go into finance and it's very, very mentally challenging. And every firm, whatever, whether they're selling Coke or they're selling insurance or they're selling stock, they're going to require people who are financially talented. And financial talent comes from many, many different aspects. So it's not something that is one dimensional. People in finance exist in tech companies to CPG companies, consumer product companies, all the way to insurance and banking and everything in between. So again, this is all about the finance committee. Okay, possible careers in finance. Here are some careers that you can have in finance, especially coming from an engineering side or studying pure finance and MBA. Things like investment banking, commercial banking, sales and trading, asset management, wealth management, hedge funds, private equity, investment, venture capital, corporate finance. So these are some possible careers in finance. And apart from this, every single company needs finance. Finance is the lifeblood of how companies run, whether that's accounting or whether it's investment or whatever it may be. So why study finance, right? So it's going to affect your personal life and as well as your professional life. In your personal life, it's something whether you're buying a car loan or a lease. Is a loan more important or a lease more important? Should I pay upfront for something or should I pay EMIs over the next 3 or 4 years? Should I buy a particular stock or not buy a particular stock? Is it a good investment? When I'm buying a house, what kind of valuation terms am I looking for? What kind of interest rate am I looking for? How better can I deploy my money? Should I go to bank A or bank B? These are personal life decisions. In terms of professional life decisions, you're looking at how should my firm launch a new product? How much money should I invest into R&D? What kind of return am I looking at if I deploy a product in a certain market? Which supplier should my firm use? Should my firm produce a product or a part, or should I outsource that production? And as a startup, how can I raise money for whatever idea I've got, and how do I deploy that money? So that's more of your professional life. So the white envelope and story time I'm going to skip for now since we don't have too much time. So let's get right into it. Okay. So basically, we want to start off with the idea of equity versus debt. You've probably heard of these terms before. And guys, since we again have a few number of people on the call, feel free to jump in at any time and ask me any questions that you've got. You feel free to interrupt. It's fine. So equity, we think of it as common shares and debt as loans and bonds. Equities come with voting power, residual claim, and impossible dividends. Now, all of these terms may seem very foreign to you, but we're going to learn through what all of this means. Debt, loans and bonds are no voting power, fixed rate payment with interest, and priority in bankruptcy. So basically what we can say is that when I'm looking to get into finance, whether it is spending money or raising money or deploying money, I'm looking at either giving out equity or giving out debt or buying equity or buying debt in a broad scale of things. Now, when I go into a market, right, I need to understand what type of market am I raising money or spending money in. There are two different types of markets. One is the capital market and one is the money market. So the capital market is where outsiders provide long-term funds, very important that is long-term, in exchange for a fixed payment. So in case of debt, it's fixed payment. In case of equity, it's a share of future profit. So I'm going to give you money now for the long term, and in return, either you pay me monthly or you pay me when you have some future profit, or I can sell my ownership in your company and gain some profit in the long run. Money markets, on the other hand, are outsiders who provide money in a short term, less than 1 year, in exchange for fixed payments. I'm going to give you 1 lakh now, and within now till next September, you'll pay me back 1 lakh with 10% interest divided by 12 months every month. And in 1 year, it's done. You deploy that money how you see fit. So the money market is more spot trading and more focused on short-term investment, whereas capital markets are more about long-term investment. Then we go to the actual financial markets, right? When I look at a financial market, there are primary and secondary markets. Now, this is more on the firm side, whereas a corporation, when I'm looking as a corporation, I want to raise money from the public, right? Or as a public, I want to invest in a particular company. I can either do it as a primary market or a secondary market. The primary market is the initial sale of security, and the security can be equity or debt to investors. Now, the primary market generally is closed off to normal investors because a company wants to deal with fewer number of people who give them a lot of money. So if I want to raise, say, $1 billion for my company, I want to talk to five investors who give me an equal share of 1 billion, say 200 million each. Whereas a normal person like me or Kanak or Sandeep or Anaga, we can't invest 200 million in your company. We may want to buy 1,000 rupees worth or 10,000 rupees worth of stock. That's where the secondary market comes in. So the primary market is the initial sale of equity from the issuer to the investors. The secondary market is the subsequent trading of these shares. So say that I have a startup and we go public and now we have a bunch of investors. We sell it to those investors want to give us money and we want to give them ownership in the company. We sell off that ownership to them. They then take that ownership and then they resell that back into the secondary market. So I can buy it from say Goldman Sachs or Morgan Stanley, and I can take that and I'm the owner of that security. Now, if I want to sell that security, Sandeep on the other side of the world may want to buy that from me. So I'm going to sell him that security. And we're going to get into a lot more details. This is still the first class of this whole thing. So a lot of this will be going over your head. We're going to get into all of these details soon. So what we do is trade in the secondary market. When I say I'm going to buy Apple stock as an individual consumer, I'm talking about buying in the secondary market. If I'm going to invest into Tata Steel or Reliance, talking about the secondary market. Now, these are exchange markets or over-the-counter markets. Exchange market means that something like New York Stock Exchange, where I'm exchanging with somebody else on the other side of the market. The market is there to match buyer and seller. Over the counter, like NASDAQ, is a broker dealer where they will hold a certain amount of stock and you are buying it from them directly. So they will purchase stock at a certain price and sell it to you at a certain price. Whereas a exchange market will match a buyer and seller. I want to sell for $5. Kanak wants to buy for $5. Done. Money will change hands. They'll take commission on that, and the stock will trade between me and Kanak in the secondary market. Now, why are secondary markets important? Is because they establish the value of a firm's security. If Kanak tells me that I will only pay you $10 for Coca-Cola stock, I tell him, no, I want $20 for it. Right now, we'll negotiate. We reach $15. Okay, that means one stock of Coca-Cola is worth $15 in the eyes of the secondary market, which means that if Coca-Cola has 1 million stock, right, 1 million stock units outstanding at $15 per stock, their company is valued at $15 million. For example, so the value of a company is established in the secondary market and it evaluates a firm's capital budgeting decisions. So as a company with a certain market cap, I am able to deploy my capital in certain ways because I also own stock in my own company, right? The company itself, owners will own stock in it. The company can raise debt from banks based on using its own stock as collateral. So the more valuable your stock, the more valuable your company, and the better or larger budgeting and financing decisions you can make by knowing your own value. Okay, this is I was telling Sandeep before, this is very serious stuff. So it's not so easy. You're going to learn in 1 hour how to invest in stocks. This is going to be a week-to-week program we're going to be running. And at the end of it, you'll have some financial literacy that will allow you to get into the stock market. So you must have heard this term bulls versus bears. Can anybody tell me what is a bull and what is a bear? No? Has anybody heard this term before? Bull is a bull, bear is a bear. And what does a bull do? And what does a bear do? Hmm? Correct. And what does it do for half the year? Correct. It hibernates, right? So one is aggressive, always charging forward. The other one is dormant, lying low. Now, why we say bull and bear is because just like how Sai explained, just like nature, bulls believe that the market is going to go up, prices will go up. Bears believe market will go down, negative market outlook, prices are going to go down. So when somebody says I'm in the bull or the market is in a bull run, we are in a bear market. I'm a bullish investor. I'm a bearish investor. Here are where these terms are coming from. So if somebody tells you I'm bullish on Apple, that means this person believes that Apple's price is going to go up. If somebody says I'm bearish on the Chinese economy, that means that they believe the Chinese economy is going to shrink. So bull and bear, right? It's a very easy way to get started with financial literacy. So now let's just jump straight into it. This presentation I used to give this presentation in 2014 when I was still in college. That's when I used to teach this class. So this exact date is January 17, 2014. If you see, oops, I went back. Right, January 17, 2014. So this is Apple stock price back then. So here we see a company called Apple Incorporated with a interesting AAPL. This AAPL is a ticker symbol, TICKER. It's a ticker symbol to identify this company, this entity in the stock market. So AAPL, it has a certain rating. We'll get into that later. I see a price. Okay, I see $540 per share. I see a day change in price. It's down $13, and that equals to around minus 2.45%. The stock opened at $551. It went down by $13, and now it's around $540. The day range that this traded in is $539 to $552 in that one day. 52-week range is in the last year. 52 weeks is 1 year. In the last year, from today till the last year, it traded from $385 to $575. Now, if you notice, your brain is already making assumptions of what's going on with the stock. It is down. Why is it down? Red is not good. The day range, it's at 540. Okay, it's at 539 is the lowest for the day. It already reached 552 today. And the week, it was at 385 in the last 1 year. But right now, the largest it was at 575, and today it's at 540. So it's very close to the 52-week high number rather than the 52-week low number. The yield percent we'll talk about later. Market cap. This is the capital, like the value of the company is $482.6 billion. If you guys remember, Apple is now worth over $1 trillion, $1,000 billion. So obviously, since this date till today, if you owned Apple stock, you'd be a very, very, very happy investor. The volume is 5.5 million. We're going to talk about that. The average volume is 11.4 million stock units. Forward PE, I want you guys to really look at these numbers, look at these letters, and understand these terms, because these terms are going to make you understand how to understand these markets. So forward PE is price to earnings, price to book, price to sales, price to cash flow. Price is this number right here. This is the current price of the company. 10.7, 3.9, 2.9, 9.4. Don't worry about what each of these means right now. Just be familiar with the terms. Tell me, please. Per stock unit, one stock unit. No, 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 no. So, like I said, right, if you go back over here, what does a secondary market do? It is what it does is, why is it important? It establishes the value of the firm security. Something is only as valuable as what you'll pay for it. Right? So if I tell you that Apple is worth 500 and you say no chance, Apple is worth 1,000, and Sandeep says you guys are all crazy, Apple is actually worth 2,000, right? Whoever makes that selling decision, whoever pays the money, they are the ones who determine the value. So when this happens at a large scale, so the volume is 15.5 million shares, right? So 15.5 million shares have been traded in that day. Okay, so 15.5 million shares have been traded. That means 15.5 million transactions have occurred. Each transaction occurred at a different price. It's been 540.67, 540.12, 541, 540, 539. The prices are literally changing at all times. Also, there's a bid-ask spread. So I don't want to get into too much. You just remember this, there's a bid and an ask spread where prices will fluctuate amongst it. This is basically just in this snapshot in time. This is what the price is. But if you go to buy it, doesn't mean you'll get this rate. You may get 541, you may get 539. In one instance, this can become 560. depending on orders are being matched. If somebody comes in and says, I want to buy Apple at $600, right? Why will you not sell it at 600? It's already worth 540. So people will start filling the order at 600. The price will start to move up because that person who's buying at 600 believes that the stock price will be worth 1000. So he doesn't mind paying extra $60 per share today to realize a $400 gain in the next year per share. So it's completely driven by market dynamics, supply and demand. We'll get into more details about that. Okay, so this quiz you guys can forget because this is also not important. Okay, my career opportunities in finance include, who's got the right answer? Hedge fund analyst, investment bank analyst, corporate credit analyst, oil trader, all of the above. Correct, all of the above, right? Each of these is a financial career. Here are some resources that you can use, right? And next time, so we're going to go through the next lecture also right now, actually, since we have some time. And then we're going to do the next. This is a 6 lecture series. So we're going to do lecture 1 just got finished. We're going to do lecture 2, and then every week we're going to do lecture 3, 4, 5, 6. Okay, so next we're going to talk all about stocks. What is a stock? Why does a stock exist? How does a stock work? And what are company financials? Okay, before we jump into that, I want to give you guys a very quick look into how this looks right now. And let's take it in the yeah, so we looked at Apple, right? Now let me look at, I'm going to go to Google Finance. You guys can still see my screen? Okay, Google Finance. I'm going to come into AAPL, right? I'm going to look at Apple. Now you guys will notice Apple is 216, right? But Apple is worth a lot more than what it was worth when I showed you that last in 2014. Does anybody know what has happened? I showed you 540. Now I'm showing you 216. What is good? What is bad? Let's see if anybody can guess what is going on. Okay, so Sai already got the answer right on the bank. So the number of shares have increased, so the price per share is reduced. What do we call that? We call that as a split. They have done a split in the market where you can do a 1-for-2 split, 1-for-3 split, 2-for-3 split. So if one investor owns one share, now they own two shares, but each share is worth half. So we're looking at year to date. So let's look at the last 5 years. So now I see 2014 over here. So that same number that I was showing you in 2014, here is, I showed you January 2014. Now, pre-adjusted for stock split, January 2014 is now only worth $71.51. What I was showing you is 540, which means that they have gone through multiple splits since that time. Okay, so let's look at Apple stock for the last 5 years. 5 years ago, it was worth 101 US dollars. Now it's worth $216. We see that the price has moved, up, down, up, down, up, down. The price has been going. But the general trend we see has happened like that. Now we look at the current market cap of Apple is $979 billion, whereas in the previous 2014 example, it was worth 400 and something billion. It's almost doubled in value, more than doubled in value. Same way, 52-week high, 52-week low, and depending on whichever platform we are using, we can get into a lot more detail than simply what this surface level detail is. Right? I can look at the news of the company, I can look at the financials of the company. Here are my financials of the company, and we don't want to go into too much detail because we're going to be going through balance sheets and income statements later. But basically, this is how you generally look at what's going on. So the first thing you can do is get a stock tracking app, right? And in that stock tracking app, start to follow certain tickers. So there's Apple. Now let's look at the Indian context. Will be so Bombay Stock Exchange, okay? BSE top performance 2019. Oops, this is still in Google Finance. Let me just do BSE. Okay, this is the whole Bombay Stock Exchange as a market. But right now we're talking about certain stocks. We haven't reached markets yet. Okay, just 1 second. Here we go. It's opening up. This is the stock price index. Here we look at the gainers. Let's look at the trending. Who's trending right now in the Indian ecosystem or listing? Losers. Let's see who's losing. Naukri.com is a big loser right now. They've changed by 5% down. They've come. So let's look at Naukri.com because we're all familiar with Naukri.com. Okay, now InfoEdge where it went to. 1 second. Oh, Naukri.com trades. Okay, InfoEdge is the parent company. Naukri is the ticker name. So Naukri, now this is in the purely Indian context, guys. So here's the this is the 1 year stock report of how the stock price has performed for Naukri.com. We see here, like just that was dollars, here is rupees, right? And here we can see how that particular stock has performed. Now, this is giving me a lot more information about revenue, about the stock price. You're not going to understand any of this now, but it's good for you to start going to these websites. If you're interested in the Indian ecosystem, Bombay Stock Exchange, get on the website, open it every morning, get the app, follow some stocks, see how the stocks are changing. The next best thing you can do is get like an Investopedia investment app game. So get a game. The game will allow you to simulate as if you had 1 lakh in the bank. How will you deploy that in the market? So Investopedia, this will be global, so it'll be more US focused, but you can get $100,000 in virtual cash, just like how the US economy works, similar the Indian economy works. Some things are different in terms of company reporting, in terms of how the financial year is calculated, tax structures, but that's a lot of detail. But basically, in terms of how the markets move, it's very similar. All right. So what you can do is you can come over here, get $100,000 in virtual cash, and then deploy that virtually, and then test your skills in how you're picking companies. So Investopedia is a fantastic resource in general. You can learn everything you have to learn over here from the education part, but you can also use that simulator to play the game. Okay. Okay. Everybody clear on that? Any questions before I jump into lecture two? Okay. Okay. Here we go. So we're moving pretty quickly again, so just remember that. So last time what we did was equity versus debt, capital market versus money markets, primary market versus secondary market, bulls versus bears. Okay. So again, now this is 2014. Let's look at what is happening in the markets in 2014. If you notice here, you'll see some timings. You'll see North and South America, Europe, Asia. Then you also see all these different S&P, Mexican Bolsa, that you'll see FTSE 100, we'll have BSE here, you know, the Hang Seng Index. All of these are markets. In the market, there are companies that are trading. Those companies are trading their stock in that particular market because they are listed in that company, in that country. So there nothing prevents a Indian company from listing in the US. So US investors can buy into that company. Same way a US company can list within India to raise money from the Indian market and to publicly trade within the Indian market itself. So what we see is here, the market as a whole, we're seeing the movement. We're seeing in this case, FTSE 100 in the UK is down 0.12%. That means a collection of all the top 100 stocks in the UK. You take all of their stock price together, that total stock price is adjusted minus 0.12 versus the previous day. Here we see this market is closed in this case. We see the Shanghai is open in this case. And what all that means is that only when the market is open can you trade on the market. When the market is not open, you cannot trade on the market. Okay. So, and each market has its own open trading windows. Now, recap, we said primary market and secondary markets. Can anybody quickly recap for me what is the primary market, what is the secondary market? Yeah, got it. Correct. Everybody's clear on that? No questions? Okay, great. So now let's get into how are prices determined in a market. Why is it not showing my, okay. So prices are determined in the market basically by emotion and by sentiment and by technicality. But at the end of the day, it's a human driven economy. Okay, there's no robots or machines right now that are determining the price. Now, in high frequency trading, in market making, yes, there is AI, there are robots, there are financial bots that are all doing market making and market matching. But consumer sentiment is still a very important part in how people view what's going on in the markets. When a new prime minister comes in, the economy booms or the economy busts. Why? Because people believe whether this prime minister can make a change in our market or not make a change in our market. So the basic prices are determined by supply and demand. If people want something, the price goes up. If people don't want something, the price goes down. So the market doesn't care about your emotion as an investor, but the market as a whole is driven by consumer sentiment. So you and your emotions don't matter, but somehow information that is in the market determines what the market prices are going to be. So there are what we are talking about now is general finance as a whole. As an investor, each investor will have their own investment thesis. They'll have their own investment belief. They'll have an own understanding of how the market works. Different people will tell you different things, right? For example, if I tell you, does the CEO of Facebook have a better chance of making better investment decisions in social media than you do? Some people may say yes, because he knows social media so well, he'll be able to invest in the best social media companies because he has the best access to information. Somebody else will say no, the news covers everything equally, and me and the CEO of Facebook have the same access to information. So different investors have different beliefs in how the market works. What we call that is they call the efficient market hypothesis. How efficient is a market in determining what information drives how much information drives the price of stock? So there are three different levels, and each investor will have their own belief in what the level of the market is. So there's a weak form, a semi-strong form, and a strong form. What the weak form hypothesis says is that prices in the market, and this is kind of your question, right? How are prices determined? Here is your Gyan answer, right? You have to pick what you believe is true. The weak form says that prices only reflect the past publicly available information. So if a company makes a report about what they sold last year, the prices will only include that last year's information about how the price is. So if they sold a lot in the last year, the price will go up. If they sold less in the last year, the price will go down. And that is the only determining factor, is the past information available. Semi-strong form says that prices reflect publicly available information, and prices instantly change to reflect new public information. So if Apple tells you our sales last year was X, oh, and by the way, last week we sold more than we expected, then immediately the stock price will change to reflect that information. Strong form says that prices instantly reflect even hidden or insider information in addition to past and current public information, which means that if somebody has certain information, they are able to use that information to make buying and selling purchases, that even insider or hidden information is included in the stock price. So that means, so if somebody believes in the weak form, they will believe that the CEO of the company has too much information and I should not buy into this company because the CEO's information is already baked into the stock price. So the CEO will already know how the stock is going to perform in the next 3 years because they know what is going to be released. So why should I buy the stock when that future value is already in the value of the stock today? So this is again a lot of hypothesis in economics where you as an investor have to decide what you think is right. If you buy Apple at $540, do you think it's going to go up to 600? Why will it go to 600? What do you know that other people don't know? Now, if you believe in the strong form, what you know is already in the stock price. If you believe in the weak form, what you know is not in the stock price. So you can make your investment decision based on your belief of how the market works. So, since markets are efficient, attempts to outperform the market is essentially a game of chance rather than one of skill. This is what some people believe. That they say it's basically like the lottery system. It may go up, it may go down because all information is already baked into the stock price. So, what kind of market do you guys think we are in? Weak form, semi-strong form, or strong form? What about other people? What do you guys think? So, what do you guys think? Is it weak form, semi-strong form, or strong form market that we are in right now? Why is that? Why do you think that? Right. So, fluctuation of stock does not mean that it's weak, semi-strong, or strong. What it means is that why is the stock fluctuating? Right? Now, if nothing comes in the news, nothing is there in the news, and suddenly a stock takes a huge downward trend, it goes down by 10%, but you don't know why, right? It could be that the insiders of the company are selling their stock because they know something you don't know. Right? In that case, the stock is still moving, but it's a strong form because the stock is representing what the insiders know, not what you know, not what the public knows. So the more prevalent technology becomes, right, the more people are hesitant to get into the markets because they are like, what do I know? How can I know? Or forget about inside the company. Let's look at a hedge fund. Let's look at Warren Buffett, right? Warren Buffett has beaten the market time and time and time again. Do you think he's lucky, or do you think he has access to certain information that you do not have access to? Then that's the strong form, right? Because in the strong form, Warren Buffett is an insider who has access to certain information that you don't have access to because of his position. Somebody believes in the strong form means that the prices are already baked into what Warren Buffett knows, but I don't know that, so why should I buy the stock? He knows that, so he's buying it. But because he's already bought it, the stock price has already gone up. So if he bought something at 100 rupees and now it's at 200 rupees, you already missed the opportunity because he bought at 100 because he knew something is happening, so he bought into it. It's a strong from economy, so the 100 rupees that when he bought in, the stock price went up because Warren Buffett bought into it. Now it's at 200 rupees, so he's going to sell it at 200 rupees. So what's the point of you buying it at 200 rupees? When he sells it, the price will go down because the market will believe that Warren Buffett has already made his money. There's no point buying this stock. Now from 200 it becomes 150, and you bought it at 200 because you found out that Warren Buffett bought it at 100. So you see the problem that we have over here. This is why investing is extremely technically and fundamentally difficult, because you as an investor have to know what you believe in and you have to chase your beliefs. Now, I'm going to make it a little simpler for you by distilling types of investment. That way, because now what I've left you with, if I leave you with this, you guys will go home crying saying, what is up with the markets? I can't do anything in this. I'm not Warren Buffett. What's the point? Right? We don't want you guys to feel that, obviously, because this is just the baseline of how the economy works. And the economy is totally messed up. And what they say is the invisible hand of the economy. No one knows what's going on. Everything is a game of chance and luck. But there are still people making money in this business, so you have to understand why and how they are doing it consistently. Okay? So let's move on. So what are the different kinds of secondary markets? There are two different kinds, exchange versus over the counter, like I had mentioned. Exchange markets are what you see is what you get, right? They're like online broker. It's like, I want to buy Apple at 10 rupees. Okay, Kanak is going to sell at 10 rupees. Okay, they will now transfer it over to me from Kanak's account. They will take a percentage of that. What you see is what you get. Online brokers do three different types of models, and they can fill your order. If I put an order that I want to buy Tata, right, they can take that order and fill it as they wish, because the price that they're giving you is the price that you're going to get it at. But we don't know the price that they bought it at. That difference of what they buy and what they sell to you at is their margin that they get. Plus, they're going to charge you a trading fees on top of that. There are some new age brokers who are not charging a trading fee. So buy from client, sell to you, sell from their own inventory. So if suppose now I am a broker and I am going to say that, okay, I'm going to buy 100 Apple stock units. And every time one college student comes and they ask me to sell, I'm going to give a 5% markup and sell it to them. Because that student is not looking at 5% gain. That student is looking at 50% gain over 10 years. So that 5% difference doesn't really matter, but it's a benefit for me because I bought it at X price. I'm going to sell it at X plus 5%. And if I do that at a large scale, my profit is very strong. So they may buy a large amount and sell it to you from that inventory. They may also buy it from a different exchange and sell it to you. So there are three different ways in which exchange orders are fulfilled. Over the counter, OTC, we say OTC securities are more like bonds and FX. FX is foreign exchange. So you go to Google and you can find the current exchange rate for a currency pair. So you can see, okay, a US dollar to Indian rupee. So you'll see, okay, 71 rupees. Now, what you see is not what you're going to pay, because you're going to pay that plus some sort of brokerage fee, plus some sort of, like volume fees. You may have to buy $100 before they sell it to you. Nobody's going to sell you $1. They're not going to sell you $1. They're going to sell you $1,000. So it's more like a guidance of where the price currently is, but that's not going to be what the price you pay. There's no listed prices. Market makers determine the prices on and by taking risk on buying and selling securities. So market makers are people who will buy US dollars and sell you rupees. They'll buy rupees from you and sell back US dollars. So they are holding all of the risk. Okay. Now, guys, again, this is not super important because you're not going to get into like financial trading after this. You're simply trying to understand financial literacy. So don't get too hung up on all of these terms. Okay, now let's go into trading terminology. Long versus short. I'm long Apple means I'm betting that the price of Apple stock will rise in the future. I'm bullish on Apple. I'm long on Apple means that I'm going to bet that the price goes up. I am short or I am bearish on Google means that betting on the price of Google will fall in the future. Now, the question is, when you talk about this bullish and bearish is how we talk about markets. Long and short is how we talk about individual stocks. This is just trading language that is in the industry. So I'm long. So if your trader asks you, are you long? What are you long? What are your long positions? What are your short positions? Okay, I'm long Tesla. I'm long Apple. Shorting stock is a very different procedure, and I'll explain to you how does it work. But generally, normal investors who are not very sophisticated investors will tend to shy away from shorting stock, because not only does it open you up to large risk, it also requires you to be a little more financially literate in how to short a stock. Going long simply means I'm going to buy something for 100 rupees. Tomorrow it's 200 rupees. I'll sell it. I'll make 100 rupees profit minus any commission. Going short means selling something that you don't own. So how do I bet that the price of Google will go down? First, I'm going to borrow the shares from somebody. So suppose Sandeep owns Google shares. I'm going to borrow the shares from him. I'm going to sell those borrowed shares to somebody else. So the lender is going to lend me shares. I'm going to sell those shares to a buyer. The percentage, I'm going to give a percentage of the proceeds from the sale to the lender to say that, look, I borrowed these Google shares. They are worth 1,000 rupees. Here is 500 rupees I'm going to give you. You take this 500 rupees as collateral until I give you the shares back. Now I'm going to buy the shares back at a lower price. I'm going to return the shares to the lender and I'm going to keep the profit. So this is a it's a little more complicated. Don't get too wrapped up into it. If you want, you can simply search how to short a security, and you'll get a lot more information than this. Now, when we look at how to invest in a market, right, there are three particular ways. Like I said, each investor has to determine for themselves, how do I invest? What do I invest in? What is my investment thesis? What is my investment belief? There's three main styles of investment. One is value, then is growth, then is momentum. So each style has its own unique approach, and what an investor's risk tolerance is, how much money you want to make, how involved you want to be in your decision making. That is what's going to determine what style you're going to go with. Now, if I there, okay, suppose we all know Apple as a company. There are many ways to look at it. One way I can say is like, I use Apple products. I love Apple. I'm going to buy Apple stock because I support the company. And because I like this company and I like the products and all my friends like the products, I'm going to buy Apple stock and I know it's going to go up, right? That's a way of investing. Another way of investing is saying that Apple made X amount of billion of dollars last year. They made another few $1 billion this year. I believe they're going to make more billions next year. So I'm going to buy into them because I believe they're going to keep making money. Even though I don't care about Apple products, I don't use their products, the financials of the company are very healthy. And I believe that the financials are going to keep growing. So I'm going to invest in this company. Then the other way of saying is that, hey man, all my friends are buying Apple stock. I should also buy Apple stock, right? These are three different ways, and there are many, many other ways. The moon is in the right position, so I should buy Apple stock. I am a Hindu. I am going to fast tomorrow. I should buy Apple stock. There you can come up with anything. You can literally make any investment style. These are the three major ones: of value, growth, and momentum. But there are people who buy stock for the craziest reasons, and there's nothing wrong with that. I work at this company. I'm going to buy the stock. Each of these are different theses. Okay. So let's move on. Now let's take a look at each of these very quickly. Now, value investing basically says that I'm going to buy companies where I believe the price that currently exists does not represent the true value of the company. So the father of value investing is called Benjamin Graham. He's written two very, very important books called Security Analysis and The Intelligent Investor. Yeah. So these two books are must reads if you guys are going to get into the stock market. And you can get short summaries of them, but I encourage you reading the full thing. The idea is that using key understandings of finance and key metrics. Sai, can you please mute your mic? Is a little bit of disturbance coming? Thank you. So Graham would basically find the value of a security. He would say, you know what? Everybody is saying this stock is worth $100 today. I have looked at my own pricing. Like Kanak says that, oh, 540. No, man, let me just check and see what's actually going on. I believe this stock should be worth 700. So I'm going to buy it at 540 because eventually the market will realize what I have realized and the stock will move up. Because where we go back to efficient market hypothesis, right? Once Kanak believes that the stock price is not reflecting what he knows, he can get into the stock at an earlier value and say that when the market realizes it, the stock price will go up. So Warren Buffett is the best known value investor. He does his own analysis. He looks into a company just by himself with his huge team, and he figures out that everybody is saying something, but I believe something else. This is what I believe where value. So I believe the newspaper industry will not die, even though online news is going to become very important. Warren Buffett still went and bought many newspaper companies because he said, no, I believe that the value of newspapers still exists. What you guys are saying about newspapers declining, readership declining is not going to happen. These companies are going to figure out how to have offline and online. That's value investment. Okay. The next we have is growth investment. You invest in the future potential of companies. So you buy a security, and okay, guys, security. The word security is equity or debt, right? Again, we go back to security means equity or debt. So I'm buying a security whose growth potential is undervalued. So everybody is saying Tesla will sell X number of cars. No, I believe Tesla is going to sell X plus 10% cars. So if I am right, then the stock price will reflect that information. And if I buy a stock at this time, the growth of the company will far outpace the growth that people expect. Therefore, or they'll even increase based on the growth that the company is telling me. Because the company will tell you, we expect to sell these many iPhones. But you're like, no, you know what? I love the phone. My friends love the phone. Now, again, I'm telling you, like, you don't have to look at what you and your friends are doing. You can also see on Twitter what people are saying. You can see on Reddit what people are saying. You can look at other analysts from different financial firms, what they are saying, and you can figure out what your growth strategy is going to be. And you believe that the company's growth is not priced into the factor of the stock. So growth investors still use fundamental analysis, but they focus more on the potential opportunities that the firm is exploring. So suppose Apple, like yesterday, Apple announced Apple services, right? So Apple TV, Game Arcade, each of these is going to be a subscription model of $3 per, say $3 per month or $5 per month. You may believe that Apple will add on more subscription services, therefore they'll grow more than expected. So that's a growth mindset of investing. Lastly is momentum investment. You look to capitalize on the trends in the marketplace. You believe that a stock price, if something has increased in the last 1 month, it will continue to increase. If something has decreased in the last month, it will continue to decrease until a certain point. So once a stock gains momentum, the price of it is driven by demand and not by fundamentals. This is more consumer mindset and consumer mentality. So that's really a momentum investing style. So this growth, value, and momentum. Now, here we see momentum investing and how it kind of works. First is the stealth phase. That's where the smart money comes in. That's where the Warren Buffett, hedge funds of the world will come in. Think of momentum investing as stock investment as well, startup investment as well. The best investors will find the best opportunities in the stealth phase when nobody knows what's going on, right? That's the smart money. After that, there'll be a takeoff period, right? So takeoff period means that you'll come into some sort of awareness phase where the rest of the market is like, hey man, what is going on? Why are people buying this company? That's when the hedge funds, institutional investors, your mutual fund, your private equity firms, your hedge funds, they'll come in over here and they'll say, okay, dude, these smart people who I trust, they are buying. So I'm going to buy 5 million, 10 million, 100 million worth into this company or into this stock. Now, once that happens, once the awareness comes, we see the first sell off. The first sell off basically means that the people who are in the smart money, boom, they'll cash in on their initial investment in the first sell off. Because if you see how much the stock has grown, they've grown quite a bit. They'll do the first sell off. Now, because they are selling, the stock price will go down, 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 down into something that we call a bear trap. The bear trap means that people may believe that the stock price will keep coming down, but what will end up happening is that the media will come in and talk about what's happening. Man, this company made so much money. They got investment from XYZ investor. Then this pension fund bought into it. This person, now the drama is happening. The drama is building, right? The media comes in and now it's all over the stock. Now you as a normal investor hear about it. You're like, oh shit, Tesla exists. Tesla has launched a Model 3. Tesla, 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 Tesla. Everybody's going mad. So enthusiasm kicks in. Now the public will keep buying it until they go to a mad perspective where the greed kicks in. Now when greed kicks in, they say, okay, I am going to make 100%. I want to make 200%. Let me buy more. If I buy more and everybody buys more, the stock price will go up, 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 up. But what ends up happening is you go into delusional. The delusion turns into denial. The denial falls down and you have a huge reduction. We call this a stock price correction, where people are like, dude, this is not worth $1,000 a share. It is worth maybe $200 a share, $500 a share. This happened in the 3D printing market, which I invested in. So I invested in the 3D printing market in the awareness phase because I used to be an aerospace engineer and I was building aircraft using 3D printing. And I was like, man, 3D printing is going to be awesome. Let me get into it at an early stage. So I got in very early. I almost 6x my money, 600% gain. But I got into the greed phase. So I sold off over here. But then I got into the greed phase. In the greed phase, I ended up buying even more because I was like, the company is doing so well, they'll keep doing well. That greed turned into delusion. And now I own stock at a very, very high percentage where the reality is the stock is over here. So now I'm going to wait for the growth to come for it to come back. So everybody falls into this trap, right? That's called the bull trap. Now, bull, why? Because you wanted to charge ahead. So the bull trap comes in, people buy more. because they're like, okay, man, it came down enough. How much more it will come down? How can it come down anymore? Then you go to the return to normal, but normal is what? Normal is in bracket. Why? Because the public is still fueled by greed. Then the fear comes. Oh my God, what have I done? I've invested too much money. You know what? Let me cut my losses. Cut, 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 cut. Fear kicks in. Despair kicks in. And then eventually we are in the blow off phase where everybody sells the company stock, done, gone, and we return to the mean, the average stock price of where it should have been. So this is what momentum investment looks like. Now, there are so many places to make money. As a momentum investor, you will buy in the enthusiasm phase, you'll sell at the greed phase, you make money. You'll buy at the greed, sell at the delusional. You'll sell at the denial, you'll buy back in the return to normal. You do a sell shorting strategy. Now, the problem is that all of this information is past performance. And like we've heard on the radio, past performance is no indication of future success. So when you are in a bull market, when you are in a bear market, right, this whole thing is hidden. Wait, let me annotate. Pointer options, pen, right? Oh, I could have done this the whole time. Okay. So you cannot see any of this. When you are here, right, you are only seeing up, 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 up. You'll think this is going to happen, but reality kicks in and boom, it goes negative. When you are here, you think the bear tribe is going to go down, 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 down. But what happens is that the media picks up the attention, it goes up. So when you are sitting here, you don't know whether this is going to go this way or it's going to go this way. So as an investor, you have to figure out what is my risk tolerance, how much risk am I going to take. So this is the crazy, crazy, crazy game that you need to get into it because it's very mentally challenging. And this is why the financial market is very, very draining on people, right? Because there's a lot going on. It's not so simple. So the holding period that we talk about, guys, we're almost done. I know it's 7:01 right now. Do you mind if we finish this lecture first before we end the call? Guys, is it okay if we go on about 10 more minutes? Are you guys all okay with that? I'm thinking of Jasir and Anaga. Are you guys okay with that? Okay. So the holding period. Holding period is okay. How long do I want to hold on to a stock for? Right? Value and growth investors, they will hold on as long as the stock it where it should be, right? Or when the growth is realized. That's very important because they don't care. I believe Tesla will be worth X. I don't care what happens today, tomorrow, next year. I will keep holding because this is my investment belief. Momentum investors they'll hold on to ride the wave as long as it makes sense. So a momentum investor will only stay in this area. They don't care. By the way, let me clear out this whole thing. How do I pointer options, erase all, eraser, right? They will only stay. By the way, guys, this entire period of time may be 1 year, it may be 1 month, it could be even be 1 day. In the finance, in FX, in foreign exchange, this whole thing could happen in 1 hour. This whole thing, right? So don't think that this is like a 10-year period. Depending on what type of security you're in, it's going to be a different type of holding period. So momentum investors, they're generally shorter periods. You can also call them day traders or momentum traders or whatever it may be. If you believe your investment thesis will be willing to be taken some, so if you believe in your investment thesis, you'll be willing to take losses before your long-term gains. So you don't care if the stock price goes down 5% because you are in it for a 40% gain over 5 years. And please do not bring your emotion into it. If you want to be emotional, watch Netflix. If you want to invest, you need to be stone cold, right? It gets very exciting, which is why I really want you guys to all download the stock simulator because even with fake money, you will be so pressurized to take the gain. You will be like, yeah, I already made 20%. Let me just take it. But your investment thesis says wait for 30% gain, right? Or you'll be losing money and you'll say, I've already lost 5%. Why should I stay in this longer? But your investment thesis says, no, in 2 years, the company will be at the value that you wanted to be at. So don't follow your emotion, follow your math, your science, your skills, and whatever investment thesis you've built for yourself. Liquidity. Liquidity is the ability for a security to be converted into cash. Liquid means cash money. Okay. Illiquid means you cannot get cash. Now, what is liquid? Liquid is if I have 10 rupees, I can give you 10 rupees. If I have an iPhone, I can sell it tomorrow. There are many people who buy an iPhone. If I have some futuristic device that nobody cares about, or if I have a phone from 1995 and I go to the market and I say, guys, who wants to buy a 1995 phone? It'll take me a lot of time to find a buyer. So we call that illiquid. That's an illiquid asset. A liquid asset is something that people want that can be converted into cash very easily. Same like that. That's how we talk about stocks. Now, Apple is a very liquid stock because there are many buyers and many sellers. Some small startup may be very illiquid because people don't know about that company. They may not be willing to buy that company. So that's very illiquid. So examples of illiquid I just gave you. If you're a buyer and no one is willing to sell, then you are in an illiquid market. If you're a seller and no one is willing to buy, then you're in an illiquid market. And liquidity is important because it allows you to get in and get out of a market. But now remember is that if something is very liquid, that means many people are trading in it, many people know about it. So if you believe in the efficient market hypothesis, you may say that, okay, the more people in it, the less secretive it is. So the less opportunity there is. So there are some investors who only deal in illiquid companies. They may go to Pakistan and buy stocks in Pakistan because in Pakistan there are not that many investors. They don't have that much media attention, but they may have to sell over a long period of time. If they want money right now, they may have to wait 1 week. They may have to wait 1 month, but they are okay because what happens in illiquid commodity is that less people are talking about it, so less information is there. So whatever information you have is much more valuable. The dangers of a highly illiquid market are that you may have a huge gain, but nobody is willing to buy from you. This is what generally happens in the startup ecosystem. Your startup may be doing really well. You're an employee at a startup. It's doing really well, but nobody is willing to buy it because you cannot sell it to anybody because you're tied into some long-term contract with that startup that you cannot sell. Market capitalization. Market cap simply is the price of one share multiplied by number of outstanding shares. That's the number of units, share units. So the outstanding shares are all shares purchased and owned by investors. Now, why is this important? The more number of shares, the more number of tradability, the more liquid something can become. The less number of shares, the less people hold it, the less buyers and sellers, the more illiquid it becomes. Less number of shares means that if you want to buy some shares, it's going to be harder for you to buy it. Now, in the US and global system, in India, this is different because we talk in crores and our companies, in the terms of number of companies, we don't have that many companies, as many large caps in the US, but in the global sense, a large cap company that has a market capitalization of 10 billion. Apple's market capitalization is 950 billion. They're a mega cap. Mid cap is 2 billion to 10 billion dollars. Small cap is under 2 billion dollars. Now, this is important, like I said, because the number of shares and the price of the share is all important in your decision to buy. Like if you buy into a company and you cannot sell it, you may be stuck with that company for a longer time than you're comfortable with. And in that time, the stock price could go up or down, affecting you and affecting your returns. So now the investment committee that we were running, our investment style, we were in endowments, we had to be smart. This is how we were thinking about it. We were long only focused, we were growth focused. Our holding period was 6 months plus. We were focusing only on large and mid caps with high liquidity. We were okay in the alternative sector. ETFs are exchange traded funds. I'll talk about that later. Fixed income was also okay. So here is our investment style. So all of you need to write down what is my investment style, right? Am I going to invest in long term? Am I going to invest short term? And when you write this down, then you can start filtering for companies using online tools to find these type of companies. What should I invest in? Then by understanding how to invest, you know, okay, what price I should invest in. Okay. Now, there's two types of approaches. One is a top-down approach. One is a bottom-up approach. The top-down approach says I'm going to look at a large theme, then I'm going to look at an industry, look at a subsector, and then look at a company. Bottom-up says I'm going to look at the company, then I'm going to look at the sector, then I'm going to look at an industry, then I'm going to look at a macroeconomic theme, a national theme, then an international theme, right? So a top-down approach could be there's been solid manufacturing growth in China. Cell phone industry is benefiting from this growth. Cell phone assembly companies are generating this growth. Invest in cell phone assembly companies like Foxconn, which makes iPhones. Bottom up example. My local grocer has some awesome yogurt. The yogurt is super tasty. This yogurt can be found everywhere. Wow. What company makes this yogurt? What are the yogurt sales like for this company in Bangalore? The yogurt industry seems to be doing really well this year. The healthy food industry seems to be doing exceptionally well this year. Let me invest in a conglomerate or an ETF that is investing in yogurt companies. So I'm going to invest in Whole Foods, for example. Okay. So I'm now going to invest in the healthy consumption market. But where it started from was because I think yogurt is very tasty. So it's a bottom-up approach. Next, we look at this picture as a presentation, you don't have to worry about. Okay, and guys, we're done. Great. So now the quiz time. Who is the father of value investing? Sai, I don't want you to answer because you're getting all of these right. Between, I think we have only Jasir and Sandeep and Anaga. So between the three of you guys, who is the father of value investing? Sai, not you. I just said Sai, not Sai. Because, okay. So you guys got it? Benjamin Graham is the father of value investing. Okay. Here's a little bit of a harder one. And now, Sai, you can also take part in this one. Guys, really quickly in your mind. You shorted Apple at 750 and covered at 250, assuming $10 in fees. How much did you make or lose on this trade? Sai, if you know the answer, don't answer yet. I want to give Jasir and Anaga a chance. And Sai, if you know the answer, just tell me you know the answer. Don't tell what the answer is. Repeat. You're not able to see my screen? Since that time? Oh, green icon. Interesting. Okay. Can everybody else see my screen? Okay, I think Anaga, yeah, just click on another person's profile and click back on my profile. Okay, you shorted Apple at $750. You covered at $250. 750, 250. Assuming $10 in fees. How much did you make or lose on this trade? Jasin, any guesses? It is option number two. Now let's talk about why, right? So option two, why? Because I shorted Apple at 750 means I sold it to the market at 750. But remember, it was not my shares to sell, right? I borrowed those shares from somebody else, right? For borrowing those shares, I gave him $10. I took those shares and I sold it to Jasir for 750. Then I bought those shares back at 250 and I gave it back to the guy I borrowed it at 250. He doesn't care, right? He just wants his shares, four shares he wants. That difference in shares, $500 is the value minus my $10 is 490. This is a very complicated answer also, so don't worry about it too much. Quiz time, which is not true of an OTC market. OTC is over the counter. Who can say what is not true for an OTC market? Why is that? You're right. By the way, that's the right answer, right? So the prices are not listed in a central location. There's no stock exchange, right? Buyers assume all the risk. It's not true because sellers assume all the risk because they are the ones who are first they have to buy it and then they have to sell it to you, right? Market makers are helping determine the price, so they are the ones who are assuming the risk. And fixed income is an example of an over-the-counter security. Okay, DDD. So guys, quickly open your phones if you have them. Look up stock ticker DDD, right? Tell me whether it's a large cap, mid cap, or small cap. So look at, okay, why is that? What is DDD? Yeah, so let me show you quickly. You guys can see here. Actually, what's really funny is DDD has decreased. Okay, it's not a Korean dance song, DDD stock. Okay, here. So actually, what's interesting is that this is one of the 3D printing companies. Okay, here we can see. Now, do you guys see the momentum investment problem? Exactly like that chart, right? You see over here, the bull market came in, the bear trap came in, then, oh, the greed, the greed, the greed, the greed. Oops, this is not worth that much. Oh, I'm getting scared. And then look over here, it pops back up. It pops back up, but then boom, revert back to mean. Right here, you can see clearly momentum investment. This is the stock that I was telling you about. Now, at this time, when we wrote, when in 2014 over here, this used to be a medium cap. Now the market cap is only 949 million. This is now a small cap stock. Actually, when this presentation was made, it was a mid cap stock. Now it's a small cap stock. Okay, guys, the next time we're going to be talking about the time value of money. Super, super important. And I'm going to leave you with one question. I don't want you to answer it now. Is 1 rupee today more valuable than 1 rupee tomorrow? Okay. We're going to go through financial statement analysis, income sheets, balance statements, cash flow analysis, 10K and 10Q, which is quarterly and annual statement reporting. This will get you really into the deep of, okay, how do you analyze a company ready for investment? All right, guys, that's pretty much it. Discard. That's what we've got for today's SDT. Thank you guys for joining. That's what we're going to talk about next time. Any questions that I can answer right now really quickly? Okay. All right, guys. Thank you so much for joining. It's always a pleasure having you all here. Hopefully you learned something. Was this useful, guys, or was it too much information, too little information? You already knew this? Great, great. Kanak, Jasif? Okay, great. All right, great. All right, guys, thank you so much for joining. I'll be in touch with you all soon. Anaga, let's have you in the office with your team so we can discuss more about the product concerns you've got. And yeah, we are already working on some stuff, so I can show you some of that stuff that we're working on, and we can get a good idea of like how we're going to supercharge OneUpIt's growth on your campus. Yeah, awesome, cool. Thank you, guys. Have a good evening. Bye. Good night. Bye.